Over the past few months, the US dollar has been rising steadily as markets anticipated that Trump's policies would both impact other economies and lead to more interest rate hikes from the Federal Reserve. However, after a gradual but mild decline throughout February, the past few days have seen a sudden slump, with the dollar falling to its lowest point this year. In this video, we'll dive into the reasons behind the dollar's sharp drop and explore the broader implications for America and the global economy. To understand what's happening, it's crucial to have some context. The dollar's surge began when it started looking like Trump might win the 2024 election. As soon as his victory became clear, the dollar strengthened rapidly against other currencies. One of the best ways to track the dollar's performance is through the dollar index, which measures the dollar's value against a weighted basket of currencies. This gives a more comprehensive picture than comparing the dollar to just one currency, like the euro or the pound, because such one-on-one comparisons reveal as much about the other currency as they do about the dollar. According to the dollar index, the dollar began climbing steadily in late September, peaking in early January at a nearly 3-year high. In fact, that peak almost understates the dollar's strength. If you exclude the brief spike at the start of the pandemic, when investors rushed to the dollar, considering it a safe haven in times of uncertainty, January's peak marked the strongest dollar the world had seen since 2002. So, what triggered this surge? There were three main reasons. First, investors expected Trump's policies, particularly his tax cuts and tariffs, to drive inflation higher. Higher inflation would, in turn, push the Federal Reserve to raise interest rates, making the dollar more attractive to savers and investors. Second, many believed Trump's trade wars would hurt other economies more than the US, making foreign currencies less appealing and indirectly boosting the dollar's value. Since the dollar's strength is measured relative to other currencies, any decline in those currencies would make the dollar seem even stronger. Third, there was optimism among U.S. businesses that Trump's promises of tax cuts and deregulation would fuel economic growth. This optimism was compounded by the belief that advances in artificial intelligence could further accelerate growth. But in the past few weeks, the dollar's trajectory has sharply reversed. While February saw a slow decline, the past few days have brought what could reasonably be called a crash. As of Thursday morning, the dollar has fallen to its lowest point since the election in November. Now, this might sound dramatic. After all, the dollar is still relatively strong by historical standards, but what makes this drop so noteworthy is the speed of the decline. It's the sharpest drop since the pandemic. What's more surprising is that this is happening while Trump is imposing hefty tariffs on countries like China, Mexico, and Canada, policies that, as mentioned earlier, should theoretically boost the dollar. So, why the sudden downturn? As with most movements in the financial markets, pinpointing the exact cause is difficult. One possibility is that Trump's tariffs are more targeted than investors expected. Universal tariffs, which Trump had hinted at during his campaign, haven't materialized. Additionally, the assumption that the U.S. would lead the global AI race is being challenged. Chinese companies like DeepSeek and European firms like Mistral have made significant advances, casting doubt on whether the U.S. will dominate AI-driven economic growth. However, the primary reason seems to be growing fears that Trump's policies are pushing the U.S. toward a recession. We covered this in more detail in a previous video, but the gist is that Trump's unpredictable decision-making, especially regarding tariffs, has created a climate of uncertainty. This uncertainty has dampened consumer and business confidence, making a recession seem increasingly likely. It's worth noting just how uncertain things have become. The Federal Reserve's Trade Policy Uncertainty Index, a tool designed to measure market anxiety over trade policy, is currently 12 standard deviations above its historical norm. More broadly, overall economic policy uncertainty in the U.S. is at its highest level ever recorded outside of the pandemic. This mounting uncertainty has made the U.S. less attractive to investors. Simultaneously, it's reduced the likelihood of further interest rate hikes from the Federal Reserve. While Trump's tariffs and tax cuts are expected to be inflationary, the Fed is unlikely to raise rates if the economy is already teetering on the edge of a recession. Rate hikes, after all, tend to slow down economic growth even further. At the same time, there's a growing sense of optimism surrounding other major economies, especially in Europe and China. Both regions have recently announced significant stimulus measures to bolster growth. In Germany, for example, the government has decided to abandon its so-called debt brake and plans to spend hundreds of billions of euros on infrastructure and defense. Meanwhile, the European Union has announced plans to borrow an additional 150 billion euros to fund further defense spending, spurred by Trump's decision to scale back support for Ukraine. Though questions remain about the sustainability of this debt, in the short term, these measures are expected to stimulate growth. Goldman Sachs has even upgraded its growth forecasts for Germany and the Eurozone, with especially steep increases projected for 2026 and 2027. Similarly, in China, the government has unveiled a new stimulus package aimed at propping up the economy in the face of Trump's escalating tariffs. As recently as Thursday morning, Chinese officials signaled a willingness to introduce even more stimulus if the country appeared unlikely to meet its ambitious 5% annual growth target. In essence, while markets have grown more pessimistic about the U.S., they've become more optimistic about other major economies. This shift has accelerated the dollar's decline. Interestingly, the dollar's weakening isn't entirely bad news. From Trump's perspective, a weaker dollar makes American exports more competitive and could help reduce the country's ballooning trade deficit. More broadly, a weaker dollar could be beneficial for the global economy, particularly for developing nations. For one, global commodities like oil, often priced in dollars, will become less expensive, easing inflationary pressures in those countries. Additionally, a weaker dollar makes it cheaper to borrow in local currencies and service debts denominated in dollars, offering some relief from the slow-burning debt crisis that has plagued the developing world in recent years. In summary, the dollar's recent slump is a consequence of mounting fears that Trump's policies are pushing the U.S. toward a recession, combined with growing optimism about other major economies. While the decline signals trouble for the American economy, it may provide some unexpected benefits for the rest of the world. Only time will tell how these dynamics play out and what the long-term impact will be.